What if you could invest in over 40 countries with just one ETF? From Amazon and Nvidia in the US to Toyota in Japan to Rolls-Royce in the UK, imagine owning a slice of global economy through a single fund.
Did you know the All-World Market Index allows you to do just that? Exposure to 40 plus countries, 10,000 plus companies. Let us look at its constituents, why it is the ultimate form of global passive investing, how to get started, and my opinion of who should invest in these funds.
One such world market index is the FTSE Global All Cap Index. It's a market weighted index that includes large, mid, and small cap stocks from both developed and emerging markets. The index is calculated based on total return and price, just like Nifty is in India. As of 30th May 2025, a total of 10,037 stocks form part of the index across 48 countries. The US makes up 62%, followed by Japan at 6%. You also get exposure to China, India, Taiwan, and Europe, all within this one fund. Here are the top 10 constituents. You'll see how US heavy the list is, which makes sense given the dominance of US companies by market cap. Now, how to invest in this index? The Vanguard Total World Stock ETF VT offers one of the most cost-effective ways to invest in FTSE Global All Cap Index with an ultra low expense ratio of just 0.06%.
Let us get into the world of global passive investing with one click.
Now let's look at the returns of this portfolio. The ETF has done very well against its benchmark. Remember, these should not be compared against the returns in Sensex or Nifty. And also keep in mind that the returns are in US dollars. That brings us to a key consideration. You need to be comfortable assuming currency risk.
So how can you get access to this fund? Sadly, there are no local mutual funds which provide this feature. We can take the LRS route to invest in such ETFs because they are based out of US. And there are many platforms which allow you to do that: IntMoney, Vested, Interactive Brokers, and many other international brokers which are available. And this is the typical way an Indian investor can get access to invest in these US-based ETFs. The key advantage is that you get exposure to all investable markets. And there must be some markets in particular years which will do very well, and you get exposure to them. And you get excellent diversification. And this is the basis of genuine passive investing. And what does this diversification allow us to do? It reduces the overall risk we are taking and aims to deliver more stable returns. But please remember, this adds another layer of risk to over the market risk which you are taking, which is the currency risk. Currency market are generally as fluctuating as the underlying markets themselves. So that adds another layer of uncertainty to your returns. And we should be well aware of this when we invest through this ETF or index fund. In theory, this ETF is useful for all the investors. However, my personal experience or my personal belief is that it is useful for one, people who have built fantastic domestic portfolio and need exposure to global markets. Number two, it is also useful for people who are trying to invest in emerging markets or other markets which are not available easily to invest. For example, China. Also good for people who travel internationally and want exposure to that particular country's local currency. Please be aware, this particular video is being taken for educational purposes only. This is not an investment recommendation. And personal disclosure, I do not have exposure to this particular ETF. If you learned something new, please click subscribe and share it with your friends.